Hi, and welcome to the next episode of the Elite Wealth Podcast. I'm Patrick, and I'm joined by Matthew and Victor. And today, we're going to start off talking about the most used app on our phones. And then after we do that, we're going to talk about savings, cash investments versus brokerage accounts. So I'll go first. I use probably X the most on mine when I'm on it. Second one would be Tower Defense, which is a game I play. And I would say that's number 2. So there you go. So who wants to go next?
As Victor composes himself.
I'm just off to a good start here. Victor, back to you.
All right, I'll go. Well, for my phone, in the summer, definitely, because I grew up on a farm and we always cared about the rain, the weather. So I check the weather app almost every day, whether it's for my apple trees, food plots, that kind of stuff.
I think your apple trees are dying, aren't they? Or dead?
No, they look pretty good.
Are you supposed to get any rain today?
Not for the next 4 days.
Mr. Weatherman.
We're supposed to have about 5 days of rain starting Friday, I believe. So that'll be good.
So
I check the weather all the time.
Take that to the bank.
And then the other app, which I think a lot of younger and older individuals are using a lot too now, is whatever version of your AI chat you have. So I have Claude, so using that for literally everything. I think it knows my children's names. It knows a lot about our family.
Don't you think that's dangerous, though?
I don't. They're not going to do anything. But no, like when our kid is sick, we'll type in all the symptoms. Like for sleep training, getting him in his big boy bed, we typed in all that, tell it all of the like different things he does, and it spits out all this great information. It's really cool. So if you're not using an AI type of chat, it's super beneficial.
So is that why you didn't get any sleep last week? Okay, must be.
It may not work all the time, but it gives good
That's my
advice.
biggest thing with AI. Is it?
No,
sometimes it's got stuff, but a lot of times it's not great stuff in there.
It was really cool though. Like a lot of the stuff for my son, it's crazy.
That's not the Office, Claude, is it?
I plead the fifth.
Okay. How about you, Matthew?
Well, my 6-year-old son, his favorite app is
Tower Defense.
Yours?
Tower Defense? Nice. Yeah, that's right. Hank and I are going to do some Tower Defense. Absolutely.
I remember playing that in elementary school.
Yeah.
They didn't have it in elementary.
You're
not that young. You're not that young, buddy.
Wait, do you play Blue and Tower Defense 1, 2, 3, 4, 5?
Whatever.
That was the thing. I probably use the most during the day. It's called Stock Twits.
Of course you do.
It's just tracking the stock market. It's almost like Facebook for the stock market. People can post. You see all the different earnings and then what people are commenting on in terms of different things with the companies as they go up and down. And then outside of work, I probably use most often YouTube, just listen to different people or music. So
I do like Spotify though too, and
Spotify is good
for that. I like Spotify.
Definitely worth $10 a month.
I don't pay for anything because I'm cheap, so I just listen to the ads.
yeah, but I do the same thing.
That's right. But the thing I like about Spotify is that you can share playlists with others, which is really cool. My son showed me how to do that this weekend. That was a lot of fun. So anyway, so now on to the main topic du jour. We're going to talk about savings, and we're going to talk about brokerage accounts and how they're different and how they work. So first of all, I'm going to throw it to Victor. I'm going to Victor just describe, first of all, what's the difference between savings and a brokerage account? Just generally high level view of what's the difference.
Yeah, general bird's eye overview of savings versus a brokerage account. When you think of savings account, most people would think of a bank account. So I consider a savings account, your checking account, your savings account, maybe a high yield savings account. You can even throw a few, high yield accounts in there as well. But essentially, it's an account that's getting probably low interest, but it's 100% liquid. So it's cash you can access whenever you need to. That compared to a brokerage account, which is completely different. In general, I tell people that a brokerage account is like a bank account that you can invest however you want to. So in a brokerage account, you can put in as much money whenever you want to. You can take it out whenever you want to. But the nice thing is you can invest in whatever you want. So stocks, bonds, mutual funds, ETFs, CDs, money market accounts, the whole nine. The difference is it's taxed a little bit differently than a savings account or cash would be. But that's the big difference. You have a ton of options with brokerage accounts, and then your savings accounts is really just cash you can access.
Okay. So, Matt, with savings accounts, let's dig into that. I think the savings accounts are going to probably be a little shorter conversation, quite frankly. Do you want to kind of go over maybe like give us a couple pros and a couple cons of the savings account, maybe like how you envision them being used for clients?
Yeah. So with the savings account, a lot of times what I'll tell people is, figure out your budget, and then so much when you get your paycheck, whether it's weekly or biweekly, you do a transfer into your savings account to kind of build up a base of like your emergency fund. So, funds that are easily accessible, you can get a matter of a day, and they're there, but they're not sitting in your checking account. So typically savings accounts at banks are making a little bit more interest than checking accounts are. So checking accounts, depending on where you are, you might be making like 0.1% per year or something to that extent, right? Savings accounts, depending on which ones you're in, you might be making a little bit more than that. So the general thought of a savings account is you're making more interest, but a lot of times what we find, the interest that you're making isn't what you could be making through a money market or a CD or something to that extent. So we always like to talk with our clients about this just so that they understand and get educated. If you have $100,000 sitting in a savings account, and I've worked with people that have this and it's only making 0.5% per year, let's look and see if we can find a money market that's making 3% a year or a CD making 4% a year to make your money work a little bit harder for you. And then like Victor said, then it's understanding, all right, what level are you at? Where's your tax bracket? Is it beneficial for you to have that interest reported on your taxes each year, or is there a better way to do it?
Yeah, because you get a 1099 every year with any money on a savings account.
Correct.
Right. And then how much do you think somebody should have in a savings account? So not talking about a CD or a money market. So let's go that, and then we'll I guess go a little further into the CDs and money market. But just in savings in general, how much do you think is a good amount to have?
I say just for in savings, 3 to 6 months worth of emergency expenses are a good place to start. Everyone's a little bit different, but a lot of times you might max out your bank account as once you start getting over $20,000, maybe look to invest it another way after that.
Yeah, and I'm similar, but a little bit different. I don't like to have any more than like 4 or 5,000 in there, just because it's such dead money. And if I could put it in a money market, I could usually get it in a day. I rarely have ever met anybody that has an immediate need for more than $5,000 within 24 hours. It's pretty rare.
Right.
If you're going to buy something, I mean, I guess if you're shopping on Facebook Marketplace, you might need money right away. I don't know. But even then, usually you have a day or something to get it, or at least a little bit of time to get at it. But that's me. I don't know, Victor. What do you feel?
Yeah, and that's why one of my uncles at the farm always keeps $20,000 in his savings account because of Facebook Marketplace. It's probably his favorite app. Speaking of apps.
Yeah, I mean
Really?
that's which there is. Yeah, it's a weird place. We'll just leave it at that.
Yeah, because there's better liquid safe options than a savings account, I would say 5 to 10,000 in there. But the conversation will expand upon that later. But yeah, 5 to 10,000. And then another thing I'd mention about savings accounts too is that if you want to put the work in, you can shop around online banks to find the highest high yield savings account, and you can move your money between bank and bank every other year, however often you want to do that. So keep shopping around. A lot of people, I would say, generally use the same bank their entire life, pretty close to it, a few banks they like. Take the time to shop those around. If you're going to leave cash at the bank, we want to be making money because the real inflation rate, I think, is a lot higher than people think it is.
Well, I think the other thing too is like CoVantage, for example, is a local bank that if you jump through some hoops, you have to have so many transactions per month. You have to have like auto bill pay. You have to do a bunch of things, and then you can get like 3.5 on a savings. But you got to jump through the hoops. Some people do it, and that's fine. But it's just keeping your mind open to what's out there and the possibilities. And that's why I like to keep a smaller amount in the actual savings. But then going into somebody might say, I want to have 20, 30,000 at the bank. Then, how would we letter that? And I guess, Victor, to ask you, if you said this client A John Smith A has 5,000 in their savings and you have another 15,000 to allocate, how would you allocate the rest of that at the bank?
At the bank?
Because they want money at the bank. So,
Yeah.
So what's the best advice we can give them?
Well, again, we have to figure out what that magical number is for having cash. So if it's 5,000, we have another 15 to play with. Generally, the only other option at a bank besides a high yield savings accounts are CDs.
Mm-hmm.
So, depending on your liquidity needs, we could ladder those, maybe put 5,000 in a 6 month, 5,000 in a 1 year, and then 5,000 in a 1.5 year CD. But you're just super limited to what you can actually invest in at the bank.
Yeah, and I think that, knowing that, right, and this conversation is just pertaining around how we structure our investments for our clients. And I think the thing is looking at all the tools that are available. What can you put your money in that structurally will make you the most amount of money, but give you what you really need on here?
And one other thing I wanted to add too is, correct me if I'm wrong here, but unlike a brokerage account, interest you make from CDs at the bank, money market, or not money market, just high yield savings interest, that 1099 you get is ordinary income tax, right?
Mm-hmm.
It's not capital gain tax.
Right.
So if you're in a higher tax bracket, it might make sense to get money out of the bank and into something else.
And or it's not a qualified dividend either.
Yeah.
Which can be taxed differently. So Matt, kind of same question to you. I know that we're all on the same page, but we all have, I guess, a little bit different way to look at things, which is okay. It doesn't make it right or wrong. I think Victor's example is perfect. I'd probably do something similar, but would you do anything different? If you would, what would you do?
Yeah, the first thing I would always do, I've just noticed the different credit unions or banks in the area, is if someone says that they had a higher interest rate from a money market at a bank, just to make sure that they understand what they're getting. So it might be advertised that they're getting a 4% interest rate from a money market, but then you look into the details and it's actually a tiered schedule where you have to have over 500,000 to get that higher rate. But with where they're at with 20,000, they might only get 0.75% or something to that extent. It comes down to talking with clients to figure out what they're most comfortable with. Like Victor said, a lot of times it's a tiered schedule where most people don't necessarily need a huge chunk. So you can do CDs, but I have a couple clients where they know that they're shopping or they're going to get a new car or they're looking to go on vacation or something to that extent. So we'll hold funds in the money market for, maybe it's a 3 to 6 month period of time.
And money market is noticeably more interest-wise in most places. Not all, but most places. And I would say, from my experience right now, and this will change, if you view this later on, is that you should be able to get about 3 in the money market or something very close to 3.
Mm-hmm.
CDs should be getting you around 4. The only thing I was going to add on to what you were saying with the yield is that I was talking to a client when we were chatting about he's going to do a CD at the bank, and he said it's like 7-month CD, 4%.
Yeah.
And
is it actually 4%?
Well, exactly. And then it said an APY was 4.1 or something. It was some weird number like that. And I told him, I said, well, you realize that for 7 months you have to take 7/12 of that as your interest. That's actually what you're going to get. You're not going to get the full 4% for that. If you're expecting, you put in 10,000, you're not going to get the $400. That's just not going to work that way. It's going to be half that or about half that. So just be aware of that. Interest rates are, again, it's just another tool.
Mm-hmm.
So we go from the very, very liquid, the very, very secure. Basically, the more secure it is, the more liquid it is, the less amount of interest you're going to make, and you start working up the ladder, and then to CDs, and that's where you kind of get that. And really, most banks, like I said, and what even we can offer, it's going to be pretty similar. We can offer interest rates on CDs fairly similar. Some of the money markets are a little bit stronger through us. So again, you can always ask around, shop around. But again, this is relatively short-term money, and then every situation is a little bit different. I think is what you're saying, because somebody wants to buy a car, somebody wants to do something, go on a trip, whatever it is. They have that money. They know they can take that money out, and they need it maybe in 2 months or 3 months. You're probably not going to tie that into a CD necessarily. Probably the money market's just as good, if not better, for a lot of clients that way. So anything else you want to add?
I was going to say one caveat to that. I've run into several clients where they're great savers. They do a great job, and they have a ton of money sitting in a money market or a savings account, and they're not quite sure what to do with it. They've just built a good routine. They have a lot of money sitting there, and they don't realize they're putting money into their 401k through work, and they don't realize that they can put a chunk of money still into like their Roth IRA or IRA through work and make that money grow and still be available for them depending on what age they are.
And if they want to know more about it, if you want to know more about IRAs and Roth IRAs, that's a great reason why you should be watching our podcast. We do talk about that in detail, about how that all works and how you should do what you should do and when you should do it. So that's a great way, like I said, in order to be able to stay up to date on some of this other stuff. So today we're just staying focused on the brokerage accounts. So anything you want to add, Victor?
Yeah, 2 things. I think Matt brings up a really good point. If you have cash in a savings account or just cash at the bank, and you hit certain criteria, you're really missing the boat on contributions to certain types of accounts. So if you have cash, make sure you look into what types of accounts you could put that into where it would still stay liquid. You could still leave it as cash, but then we don't miss out on that contribution for the year. I see so many people miss out on the opportunity to contribute to Roth IRAs every year, and then you never pay tax on that money again. So make sure you understand that. And then the last thing too is at the bank, you hit on this a little bit, Patrick, but you'll see the abbreviation APY pop up a lot. Just understand what that is. That's annual percentage yield. So basically what that means is if they have a 6-month CD at 5% APY, that's what you would get if you held it for a whole year, but because it's APY 6 months, you get 2.5%. So don't let that confuse you, because a lot of people get excited, but then they see APY and don't know what it means, and they get disappointed after the end of the maturity date.
Expecting you to get 5%, you actually end up with 2.5%, which is a little bit disappointing for sure. And that's why, the other thing too is that if you do catch one of our podcasts where we did talk more in depth about the Roth IRA, the Roth actually can be a very, very liquid place, no matter what age you are, to be able to use money. So again, another reason to pay attention to our podcast. All right, we're going to switch gears because we're going to give a little more time and attention to brokerage accounts. I think maybe, Victor, you can start off. I know you described it over an overview, but let's start getting into maybe how clients would use a brokerage account as far as how is that positioned? What is that? Is that, are we calling that one of our 4 buckets? Or how are we positioning that, Victor?
Yeah, because we could literally talk about so many things with a brokerage account. It's one of the 3 tax buckets. So, if you've watched our tax podcast episodes, we talked about how you have the 3 tax buckets: the tax deferred, the tax free, and then the taxable or the brokerage bucket. And that's what this bucket is. It's the brokerage bucket. So in general, when clients have a lot of cash at the bank or extra money that they haven't contributed to their retirement accounts, we can take that cash and put it in the brokerage account. Then we're at the point where we can invest it wherever we want. So I guess to kind of break it down a little bit instead of being too general, we could talk about the taxes on it first.
Yeah, we do that. And
unless you want to go a different direction.
But well, maybe. But you did miss one bucket: the pre-tax, tax-free, the HSA.
I throw that in the tax-free bucket.
Yeah, okay. So that's
we can argue about that.
But I think the brokerage, kind of where I want to go with this and help people understand, is a brokerage account, the value of having a brokerage account. Let's start off with that. How valuable, especially pre-59.5, how valuable is a brokerage account? And why would you want to have one, I guess?
I think one of the biggest reasons it's important to have one, especially if you're going to retire early. I highly encourage people that want to retire early to add money.
What does retiring early mean? Not to be, we know, but if you're watching, you might be like, what do you mean early? Is that like not 67? Is that 66? What is that?
Yeah, because I'm an agent for the marketplace, Matt is too. When I say retire early, I was in this podcast, I was talking about pre-65.
Yeah.
Okay, pre-65, where basically you're at the point where you don't have health insurance, or you need to apply for health insurance through the marketplace, government insurance. So a brokerage account is really nice, and it's beneficial for controlling income to a certain point, because when you pull money out of your tax deferred bucket, it all counts as income. The Roth bucket is great for controlling income too, but the brokerage bucket allows us to basically pay 0 tax. I think if we're married filing jointly, our income's below about 100,000. I forget the exact number. But basically how it works is, from a tax and income standpoint, if your income's under 90,000, and let's say you bought Apple stock for $50, it grows to 100. You sell that. If your income's under 100,000, you don't pay any tax. So then I can sell that position, use that money for income, because we really have to control our income pre-65 because we have to pay for health insurance. Now, the marketplace, we don't want to go over $84,600 for our income, because if we do, then we have to pay full price for our insurance, which is like $1,000 to $2,000 a month, which is a lot of money. So brokerage accounts in general are a great way we can partially control your income in retirement.
Yeah, and I think you might be referencing as well maybe just some of the penalties around the 59.5 age when you're retiring early too.
Yeah, I think both of them are important. And actually, I was kind of thinking what Victor was saying here, just this part, and I was going to jump to that as well, because there's really 2 early retirements, right? There's the before 65, before Medicare, and then you got to control your income. And just to expand that, the income calculation Victor was referring to is your income plus the capital gains that needs to be, I think it's 105,000 is the number, but that's why we have Katie, our accountant, who helps us. She's on staff and she's able to work with our clients as well to be able to figure out where we need to be at tax wise and have all the specific numbers. But it's the combination of your income plus your capital gains. If that's under, I believe 105, then it's not taxable. But now the other part, which you brought up, which I think is important, is that another reason to have a brokerage account is what if you want to retire before 59 and a half? Because 59 and a half, you can't access or touch your IRAs. You can, in some circumstances, reach in and grab some money out of your 401k, but then you're saying, I'm going to be leaving a chunk of my money at the 401k provider, at my employer, until I'm 59 and a half. So there's some ways to do it. But again, you're going to have some rules to play by if you want to do it before that. Regular IRAs, pretty much for the most part, at 59 and a half, you don't want to touch them because you're going to pay a 10% penalty. And I know somebody recently that probably doesn't make the best financial decisions. Somebody I've been trying to help out, kind of a personal project. And she left one job, went to another job, and she was like, "Ooh, I have a 401k," and I helped her get it started, and it was awesome because she did a really nice job billing. She didn't even know how much she had in there. She had like $4,000 in there. She's like, "Oh, look at this money," and I said, "Yes, we're gonna roll that over." And then she came by to visit, and I said, "So we're gonna roll that over?" And she's like, "I spent it." I'm like, no, 10% penalty
Just
plus
like that.
taxes. Yeah, I was like, So that's just a part of it. But yeah, go ahead and expand on 59 and a half.
I think at the end of the day, it just gives you more options in terms of the 59 and a half. So you feel like you don't, if an expense comes up, it's another bucket like you're talking about before to take out of. So you don't have to use that or hit that penalty if you don't want to. And then for a couple different instances, there's some people where even before 59 and a half, certain situations, because of the other incomes in their household, their tax bracket might be at 22% already. So by taking out of a brokerage account, they would have long-term capital gains, but they'd be taxed at 15% instead of 22%. That was one situation. I remember working through that with a couple, where it's actually going to be tax advantageous for them to utilize their long-term capital gains in their brokerage account. So it's just looking at what's right for you.
Yeah, and I actually have a client who basically their entire retirement was funded by life insurance when their parents passed away. And what we're doing is we're keeping their household income under $90,000. So we have a lot of gain in this brokerage account. So they took their inheritance from the life insurance, we put it in their brokerage account, we invested it. Just for rough numbers, this isn't correct, but let's say we put in $1 million, and it's at $1.5 million now. Well, each year we're selling up to $105,000 worth of gain, and that's what they're using to for their expenses. So they're not paying any tax at all, which is really cool. It would be nice to retire and not pay any tax. Now, granted, the gains are going to get too big at some point, but the nice thing too with brokerage accounts is, let's say this specific client, $1 million invested, let's say by the time they pass away, it's $3 million, and their kids inherit it, they get a step up in cost basis. So the kids, if they inherit this money, and let's just say they sold all the positions in that account, $2 million in taxes, in growth, they wouldn't pay any tax at all. So one of the big things we do here is kind of control income and control taxes just to pay as little as possible. But if you have a lot of money in brokerage accounts, which I would say the average person doesn't.
Correct, yeah.
But if you do, there are a ton of tools and tricks you can do to save money on taxes. So it'd definitely be beneficial to come in and chat about that.
Yeah, and I think that, if you're planning on retiring, like you're saying, especially before 59 and a half, excellent way to do it. Definitely create a brokerage account, set some money aside. The other thing too is that for our clients that are higher net worth and have higher income levels, another reason I think brokerage accounts are amazing is because you're able to generate tax-free income out of them too, not just from the capital gains, which is a strategy, but a lot of our higher net worth clients that have a lot of income and they're well over that 105, then they actually need another way to be able to create some either state or federally tax-free income. So sometimes municipal bond portfolios or individual municipal bonds specifically, and we've been working on a client for you that actually I think we got to buy some again pretty soon here. But the municipals have been a great way to generate income because after tax, they're actually getting more bang for their buck. They're getting more money in their pocket because even though the yield is lower on a municipal. So again, another way you can control your income. And when you say control when we have people, we help them control their income. Just to be clear, for purposes of maximizing their tax efficiency.
Right.
We're not dictating to our clients saying, no, you can't have an instruction income. We just want to make sure it's as tax efficient as can be.
But it's interesting, to your point, I actually saw it was a graph where if you're in the 12, 22, 24% tax bracket federally, and if you got a 4% coupon municipal bond, the return was actually 6, 7, north of 7%, just because it was saving you that much from a tax perspective.
Well, I know that sometimes they don't come up real often, but when we've looked, we've seen some double tax exempt, some state municipal issues that we could get a federal and we could get a state exemption on. For the most part, though, if you can save federally, that's going to be where the big bucks are saved, is on the federal side. So you don't have to do the state, but there's sometimes that's available, and we can look every day, pretty much find whatever fits the best on there. That's part of the reason why, again, these buckets, we're spending a little more time talking about the brokerage accounts, because I feel it's important that we help people understand the value in creating them and why it's so important to have them. And it is one of the least utilized and underfunded, I think, accounts out there, because it's nice to have a fund out there that you can draw from, and you can say, hey, I don't have to be a certain age. I can take out whatever I want. I can put whatever I want in there. And I just want to hit on one other thing that you talked about, which I think is amazing and is very, very underappreciated as well, is creating wealth through life insurance. I know this isn't a life insurance podcast, but if you think about the dollars spent and the type of wealth that it creates, I don't think nothing beats life insurance out there. The proceeds tax-free, building that kind of legacy, wealth legacy. I've seen families that had very, I would say, blue collar, which is nothing wrong with it, but kind of means, and they had a larger life insurance policy, and it really does change the life of their beneficiaries and their family for multi generations. And it's just, if it's handled correctly. So it's definitely one of those things where you brought it up. It's an amazing tool. Life insurance, tax-free, creating $100,000 of income tax-free. I mean, that's pretty incredible. And that's just something that can't be done with any other tool out there. So that's something that's pretty interesting. So we're kind of getting towards the end here, the back half a little bit. And I'm going to give you each about a minute here to kind of, if you want to explain anything, if you want to talk about setting, where do you set up a brokerage account? When is it appropriate time maybe to use us for helping those things? Is there a time you should do it on your own? Any other advice, tips, or insight that you have on savings or any of the cash accounting like that? So Matt, we'll send you first.
I would say, obviously, if you have questions, ask, because I think a lot of people get confused on brokerage accounts because I feel like they're named something a little bit different depending on the custodian that you're working with. So if you have questions or you're wondering if it's right for you, ask us, reach out to us, and we can talk you through in your situation, does it make sense, and some of the different options that you have.
Okay. Yeah, for me, I would say two things I'd want to hit on too is wash sailing. So with brokerage accounts, what you need to do every year is sit down, look at what positions have made you money, and then if maybe there's positions that you've lost money in, you can sell both of those positions and wipe the tax bill and get back into them a month later. So really dive into the taxes with your brokerage account. And then I also have a client who's very close to me, and what we're doing.
Is it your brother?
No. He's maxing out his Roth IRA.
Oh, okay. You said really close. Your dad. Okay.
Really. Not my dad, because he's not ready to retire yet. Hopefully soon. But what we're doing, he wants to retire at 62. And like most people, most of his retirement funds are in those tax-deferred accounts like 401ks. But because he's retiring at 62, he's got to get health insurance. He doesn't want to pay full price. So you need to watch where you're contributing money to, because his wife doesn't work. So they're going to have to go on the marketplace. What we did is we stopped contributing as much to his 401k, and we're taking a chunk of that money and contributing it to his brokerage account to hopefully bridge the gap from 62 to 65. So basically keep that income low. So it's really important every year to sit down too and figure out what bucket you're contributing money to and what's the end goal.
Yeah, absolutely. And those are all, good insight and good feedback. And by all means, at the end of the day, if you're watching this going, wow, that's maybe not super clear yet, and I need some more direction, that's really the gist of what we do, advice in helping folks out and becoming successful, independently successful as well for their retirement.
One other thing too.
Oh, yeah.
I think Patrick told me they're coming out with Balloon Tower Defense 6. So if you have any questions on that.
I don't even know what Balloon Tower Defense is. So I guess.
Did you see that article, Matt?
Yeah. It'll be a 7 soon.
Okay. So when you're still 7 years old yet, I guess this is what you get. So guy tries to play a game, have a little fun. All right. So anyways, if you're looking at this, going over this, and you're still a little bit confused, you want some more clarity, definitely reach out to us. You can visit us on the web at eliteretirementgroup.com. Set up a time to visit with myself, Victor, or Matthew, or Mike. We'd love to have you come on in, answer those questions, maybe help you get started on that end. Or if you just are curious, you want a full review, you can also just go to the web or give us a call at 715-341-8899. Until next week, thanks for tuning in, and we'll see you then.